In a week that's going to be dominated by the US election, the FOMC arguably takes a back seat, but nonetheless, it does provide the basis for markets to really gauge the outlook from a central bank that people had expected was going to be cutting rates by 50 basis points. That's no longer the case. So will we see this steady downward trajectory in terms of rates in the US, and will they be swayed by the results of the US election? Let's look ahead to the FOMC meeting taking place on Thursday, the 7th of November. So let's get into it. We've got a host of charts to show you, and they all have sort of implications for what the Federal Reserve might be thinking and what we should expect from markets going forward. First and foremost, here is the trajectory of Treasury yields. So when we talk about, say, the 10-year yield over in the US, why is that important? Well, the 10-year yield has been tracking primarily with the US dollar of late, right? And so whilst we've seen some upside in terms of the Treasury yields, we've seen some gains in terms of the dollar. But if you look at this relationship between interest rates as determined by the Federal Reserve and the 10-year yield, this points towards downside to come, because we're expecting that the last rate cut is the beginning of a cycle that sees interest rates from the Federal Reserve moving towards the downside. And that provides the basis for expectations beyond the US election that we will see downside in terms of the 10-year yield. If we're looking at that relationship between the 10-year and the US dollar, that would mean the potential for weakness for the US dollar moving forward. Of course, there's question marks about how this election might impact it. And people seem to think that Donald Trump is the pro-dollar candidate within that, because the so-called Trump trade has led to dollar gains. But arguably, if you look at this, we could see risk on play as we see easing coming into play, and therefore you might see weakness in terms of the US dollar going forward. This is the shift in terms of expectations over the course of the last month for the outlook for interest rates from the Federal Reserve. What we can see is there's been a massive shift towards the upside. So people expecting a significantly less rate cuts from the Federal Reserve. And that came off the back of a strong jobs report. Now, we will note that we've just come off the back of a Friday jobs report, which saw a lowly 12,000 jobs created in the NFP number. That primarily was driven by the likes of, say, education and government jobs, right? So a lot of those private jobs really fell off in a meaningful manner. But there's some question marks about how much this can be sort of cast aside because of the hurricane and things like that. So interestingly, whilst we have seen a little bit of a pickup recently in terms of expectations for, instead of 50 basis points, essentially we just saw a shift for pretty much everyone expecting a 25 basis point cut. So there was a bit of a shift. It wasn't really as significant as the move that we had seen, where we previously expected to see a 50 basis point cut, or markets had been pricing that as a significant possibility. And then once we saw last month's payrolls release and the decline in terms of unemployment rate, and now flatlining where it is, that essentially marked the signal to markets to say, look, a 50 basis point cut just isn't going to happen. And that's exactly where markets are at the moment. So you can see there has been a major shift over the course of the past month, in particular the first part of that actually, where it was just in the aftermath of it. But we also saw, so we saw the shift in terms of the jobs report, but we also saw the shift where it moved towards Donald Trump potentially coming into power. So those are the two sort of primary things that are moving the likes of the US dollar in particular over the course of the last month. But very notable that we have seen a shift towards higher interest rates, so a slower pace of easing and a potentially higher terminal rate. Inflation remains part of the problem, and that's why markets might be thinking that we won't see as many rate cuts, or that we might not necessarily see them as front-loaded as people might have previously expected. Now, if you look here, we can see that the most recent inflation report saw an upside move in terms of the services, excluding shelter. Shelter is an absolutely massive part of it. But arguably, the fact that it's so lagging and such a big part of it means that sometimes the Federal Reserve will probably be able to look beyond it and say, we think it's on the right trajectory. Because of the fact that it's so lagging, we think it will continue to move towards the downside. And you can see that with this light blue line at the top, 4.85, it does continue to move towards the downside. But core CPI up to 3.3. That services excluding shelter moving towards the upside. The core excluding shelter moving towards the upside. So we have seen an increase in terms of some of these underlying sticky metrics led by the services sector in particular. That's going to be a warning sign. Of course, the Federal Reserve has not hit target when it comes to headline CPI, core PCE. None of them are back to target. So there might be some caution about the need to cut rates so quickly, or the ability to cut rates so quickly, because you're going to be looking at on two sides, right? Is inflation under control? So will they be able to act without stirring another resurgence in terms of inflation? Is inflation under control? And does the economy need drastic measures right now? And you would say last month when we saw the payrolls number coming out, that signaled that the economy probably doesn't need it immediately, right? Because not so long ago, we were talking about the US potentially heading into a recession. And then is inflation under control? Well, we've started to see a resurgence in the parts of it that we really need to see driven down. It's the sticky stuff, the services stuff. The lagging shelter component is something that the Federal Reserve could probably sort of argue away. Here's the overview of the jobs market. As we can see here, that sharp decline in terms of the payrolls number coming down to 12K. But arguably, you can see relatively under control, the unemployment rate of 4.1%, average hourly earnings sort of flatlining, but has been seeing that downward trajectory. But you could say, okay, there's that 12K number. But prior to that, we'd seen it sort of relatively steady. After that prior month's reading, the average hourly earnings now sort of moving sideways. So wage growth not declining in the same way as it had previously. Inflation seeing a bit of an uptick in terms of the services and core side of things. I would say the warning signs in terms of, the unemployment rate's going to spike and the SARM rule and all that kind of stuff, that appears to have sort of faded. Markets, given the reaction to that 12K payrolls number, seem willing to overlook that. And so you can see why the Federal Reserve at the moment are relatively happy to cut rates, most likely by 25 basis points. And this also highlights those two sides of the coin, right? So the ISM services PMI, the services side is the most important side. We've, on recent months, seen volatility around the manufacturing figure, so the ISM manufacturing PMI, mainly because it's so dour, right? And so it's really a bit of a shock to people. But it's not the manufacturing sector that drives the US economy. It's the services sector that does the bulk of the work. And so you can see here, ISM services PMI moved towards the upside, highest level we've seen for some time. And we've also seen an uptick in terms of prices paid. So on one side, you're seeing the economy doing all right, well enough. And on the other side, you're seeing a potential resurgence in terms of inflation pressures. Those things put together point towards exactly what we saw a while back, which is a slower pace in terms of easing from the Federal Reserve and potentially a higher so-called terminal rate, which is like, at what point do they stop cutting interest rates? And these two lines essentially wrap it all up within a single metric, which is the ISM services PMI and the underlying prices paid element of that. Here's the outlook for markets. Essentially, they are dead set on the idea we're going to see a 25 basis point cut, 98.5% chance of that, according to the LSEG Icon platform. You can see beyond that, expecting to see a rate cut the next month. And then we start to get into January. So really, it turns into a coin toss, 45% chance of another one. But essentially, markets really pointing towards the possibility that we see a slowdown and we essentially see a cut every other meeting. This is what's going to be really interesting. As we see this meeting, it's going to be coming around the time that we should see the resolution of the US election. And so you wouldn't think that they're going to be impacted by the election, but it does feel like, okay, we've seen that pivot towards interest rate cuts. We've then potentially resolved the election. And so we're heading towards a 2025 that really starts to see a new sort of phase almost within markets going forward. And people really want to ascertain exactly what that pace of easing is going to be from the Federal Reserve. So it's going to be notable to be looking out for some of the commentary that comes out alongside it. But as things stand, you can see here, there is a skepticism around that previous dovish sentiment that we're going to see 50 basis points cuts at each meeting at the back end of this year. And then, 25 at every single meeting. It feels like markets swing between one extreme and another. And I think they're getting towards another extreme, quite frankly. I was expecting 25 basis points at each of these initial meetings, granted. But actually, if we look at the breakdown in terms of when the disinflation is going to happen, it's going to happen in the first couple of quarters of next year. That's when we're going to see a sharp decline in terms of inflation. So the idea that next year we only see a rate cut every other meeting, I think that's being a little bit cautious, quite frankly. Whether we're going to get that clarity at this meeting remains to be seen. But certainly, it always feels like these market expectations are wrong in one direction or another. When they were talking about a 50 basis point cut at each meeting, I was saying that doesn't seem likely. Now we're seeing, okay, we'll see 25 basis points at each of these final two meetings, but then from then onwards, we might see one every other meeting. I think we're probably going to see a bit more than that. But really, it comes down to the trajectory of things. If Donald Trump comes in, people view him to be inflationary. And if there's that concern about inflation, inflation is the thing that can undermine this whole thing. If we see a spike in inflation, the Federal Reserve's not going to be cutting rates, end of, right? They're going to have to stop. So Donald Trump coming into power also is going to have a key role to play in this, if he does or if he doesn't. So it's going to be really interesting to note, and you can track it. You don't have to utilize this. You can also check the CME FedWatch tool. Track those shifting expectations and do so after the election, because if Harris wins, it'd be very interesting to note whether people then view that as that the Federal Reserve are going to cut at pretty much every meeting over the course of next year. And a lot of that will come down to, the expectation of inflation according to each candidate. So that will be really notable as well. I can't argue that, the market moves are not going to be driven by the US election, because arguably that's the big ticket item of the week. But here is the chart for what we're looking at. SPX. So this is the S&P 500 over in the US. And you can see this sharp pullback into the election. Now, I've done a couple of major breakdowns in terms of this US election. So make sure to check that out on our YouTube channel. But by and large, you often see this. You see the uncertainty coming into the election. And then depending on the result, of course, you often see that relief rally, because equity markets do well at year end, particularly after the election. So generally the bull run kicks off after a poor September. We see a strong October. In election years, that generally actually happens in November. Notably, we did see a strong October, but actually right at the end of it, we saw undermined, and it reversed pretty much the entire gains of the month. So we've seen near enough a flat October in the end. But look out for support here, 56.74. A break below that level does negate this uptrend that we've been seeing over recent months since the lows in August. But nonetheless, we're looking at a market that I think towards year end generally should be in a positive footing. And certainly if we get through this election with a result that markets think is palatable, I think the bulls will be back into place soon enough. And then they start to look towards the Federal Reserve. Are we going to see a 25 basis point cut? The answer is pretty much yes, according to expectations. And therefore, the volatility is likely to come around expectation for 2025 instead. I think there's a little bit of a cautious tone when it comes to a cut every other meeting. So depending on exactly what happens with the election, that could provide the basis for potentially a bit more of a dovish outlook from the Federal Reserve if they don't fear inflation as much, or maybe they just want to be cautious and come out with a relatively data-dependent outlook. And then this is euro dollar, notably rebounding off of this trendline support. So we've seen dollar strength recently as we see a ramp up in calls for Donald Trump to win. But now over the weekend just gone, we've been seeing some talk about Iowa potentially going to Harris. That has seen the US dollar start to turn around, which is a continuation of the weakness that we've been seeing over the course of the past week. Now, I would say that we have a very clearly defined trend. And unless we see a breakout of that trend, which would mean a breakdown through trendline support or a breakdown through, let's see, the swing low that we have down here, which is your 1067, then there's certainly the basis for a potential bottom to come into play here. As we can see here, we've got this intraday higher high, higher low in play. So a breakdown through this 1083 would really start to negate this rebound that we have seen of late. But if we look at sort of post-election periods, what does the US dollar do? Well, generally the US dollar strengthens when we see a new person in the White House, i.e. it would be Donald Trump coming in. So a shift in terms of the party leading it generally does benefit the US dollar. So if we were looking for a Trump victory, then you could potentially see this start to weaken from here. A Harris victory, likely to see a resurgence in terms of euro dollar. But then, you know, the key thing here is, do we see this as a reason for concern within markets if Trump does win, right? And that's not a given. A lot of the policies that people might think of as being inflationary and therefore dollar positive would potentially be undermined if we saw Donald Trump not take both sides of Congress. So whether he wins, key, but also whether he takes the House and the Senate, also key. But this Federal Reserve meeting is going to be a 25 basis point cut according to market expectations. But you can see why the Federal Reserve is a little bit cautious. We've got strong economics, relatively strong economics, despite this 12K reading that people don't know whether to believe or not, really, about whether that's indicative of a weak economy. But if you look at that ISM PMI, we see a rebound in that figure, but also a rebound in the prices paid. So that underlying inflation pressure really does give cause for concern and potentially means that the Federal Reserve takes its foot off the gas until it can be more confident that we are going to see this major disinflation, which is likely to come in the early part, in the first half of next year. So yeah, hope that's been useful. It's going to be an absolutely massive week for markets. So Federal Reserve rate cut looks to be just one part of a fireworks show that looks to kick off on Tuesday when the US electorate head to the polls.